Hey everybody, how's it going? It's Russell Matthews here again, and I just wanted to talk a little bit today about the power of real estate investing versus investing in the stock markets or investing in funds, mutual funds, ETFs, and why I think that real estate investing can be so much more powerful than those other investing strategies. To make the difference really clear, we're going to look at this from two fictional characters. The first one is Fred, and the second one is Tim. Fred and Tim both make the same amount of money. We're gonna go with the Canadian annual average income. As of 2019, the average Canadian makes $52,600 per year. So that's the number we're going to go with. Let's assume that Fred and Tim both make this average annual income. At the start of each of their stories, they're on the exact same terms. They're both making the same amount of money. They're both paying $1,400 a month in rent. It's just the strategy they used for investing is going to be a little bit different. At any point in this video, if you see anything that's of value or anything that you're interested in, drop a like or drop a comment in the video. It really helps out with how many people get to see it because of all these social media algorithms. Drop a like, a comment, it'll help somebody else who might want the information to see it too. Fred and Tim are both financially conscious, so they make the smart decision to take 20% of their income and they put that towards their saving and investing goals. 20% of that $52,600 income comes out to $10,520 per year. That's gonna be going towards investing for both. Fred's going to take that $10,520 each year and put it into the stock market at about 10% return, which is actually pretty good for the stock market. Sometimes it's less, sometimes it's more, depending on the portfolio. But for today, we're gonna use that 10% number. Now, Tim is gonna take that $10,520 per year for his investing and saving, and he's going to put that away and he's going to put that towards real estate investing. Tim realizes that it's pretty important for him to get into real estate, so he's going to focus his time for those first couple years on learning as much as he possibly can and saving the money so that he can one day get into real estate. So let's take a look at both Fred and Tim and sort of track them year by year to see where they're looking and where they're ending up with their investments. So for Fred, the first year he's going to put that savings amount, that $10,520, and he's going to earn 10% on that. 10% on his money brings him up to $11,572. Not too bad. Fred will keep doing this for the next couple of years, and he'll end up at year 3 with a total return of $38,174. Now remember, that's him putting in that $10,520 each year. Tim takes that $10,520 and puts it into a savings account for 3 years. Wants to kind of build up a nest egg so he can get started in real estate. At the end of those 3 years, Tim ends up at $31,560. Now that Tim has this nest egg, he's going to take year 4 and he's going to use that to get his first property and get moving in real estate. Tim makes the good decision to find an investment-focused realtor. Now these are the kinds of realtors that invest in real estate themselves, know about the market that you're looking in, and also have connections to other people who you're going to need to leverage so that you can do what you want to do in investing. The realtor that Tim finds refers to him a really high quality mortgage lender. So this lender is going to be able to help Tim get pre-approved before he goes out and buys that first property. Eventually, the investment focused realtor finds Tim a good deal. This deal looks really ugly from the outside. It's got vegetation growing outside, and it's even worse when you get inside. It's got carpets everywhere that smell like cat pee. It's got everything wrong with it. Super dated. It looks like it's from the 50s and nothing's been changed since. But the owner had the sense to upgrade the systems. So there's no knob and tube wiring. They've got a new furnace, new roof, and all those big major systems are A-okay. The bones are good. Tim goes ahead and buys this property for $400,000 with 5% down, so that's $20,000 as a down payment. Because Tim's been saving for these few years, he uses that money he's been saving as that $20,000 down payment. Tim goes ahead and spends another $11,560 on cosmetic renovations. Remember, this is what's left over from that sort of nest egg that he's been developing for a few years. To get the most bang for his buck, Tim focuses on fixing these cosmetic problems. He updates the flooring, gives the place a new coat of paint, and gets rid of that awful smell. After a couple months, Tim has done these minor cosmetic renovations. He brings his realtor back into the picture and asks, hey, how much do you think that this property is worth now that I've updated it cosmetically? The realtor comes back and says, wow, Tim, you've done a great job. It looks incredible. I think it's worth around $450,000 now. Not too bad. Tim's spent $11,560, and by focusing on strategic renovations, he's bumped up the value $50,000. Now that the house is renovated, Tim's decided that he's going to rent it out and have roommates in the house. So let's say there's 4 bedrooms in the home. Tim will live in one of them, and he'll rent out the other 3. This is something I've talked about a lot, and it's called house hacking, and I think it's one of the best ways to give yourself a financial leg up. Let's say Tim rents out each of these bedrooms for $600 a month. Tim's mortgage is only $1,900 a month. That leaves him paying $100 a month to cover that mortgage. Let's add another $200 a month to pay for the insurance and to pay for the property taxes on the home. And just to be safe, let's add another $100 to cover any general maintenance that needs to be done in the house each month. At the end of the month, Tim is only paying $400 to live in this house. Before any of this started, Tim was paying $1,400 per month in rent. Because his monthly housing expense is so much cheaper, now it's $400 down from $1,400, Tim can save an extra $1,000 a month or $12,000 a year to put towards his investing. By saving so much on this housing cost, Tim is able to bump up how much he's saving each year to put towards investments. Over the course of this first year, Tim and his roommates helping him have paid down a significant portion of the loan, meaning that Tim has more equity in the home. Overall, over the course of the year, it would probably be about $11,000 of the loan that has now been paid off by Tim and his roommates. This means Tim has $11,000 more equity in the home than he did at the beginning of the year. Tim initially put $20,000 down as the down payment, and then he increased the value of the home $50,000. That brings him to $70,000 in equity, plus the principal paydown of $11,000. So overall, after 1 year of owning the home, he has $81,000 in equity in the home. By saving $12,000 a year on his housing, Tim is now able to pay $22,520 instead of $10,520. By adding Tim's equity to his yearly savings, he's now at a total of $103,520. At the end of year 4, Fred is currently at $53,000. So you can see right there that Tim has really increased the drive of his investment by doing strategic and thoughtful renovations on the home that he purchased. Now for year 5, we have some more factors to consider for Tim's overall return on his investment. Now Tim's investment is going to be paying him in 3 different ways. First, let's say that his property appreciates at 2% per year. Now in the Greater Toronto area, as of late, it's been a lot more than 2%, but let's be safe and just say 2%. We'll take that 2% appreciation and we'll add it to his $11,000 in principal paydown, paying down that loan each month. And we'll add his yearly savings on top of that to get the overall amount that Tim has made from his investment. With appreciation, mortgage paydown, and savings all put together, Tim has made $42,520 just that year. At the end of year 5, that brings Tim to $146,040. If we use the same appreciation, same mortgage paydown, and same savings rate for Tim, at the end of year 6, we're going to see him at $188,740. Now compare this to the same year 6 of Fred, our friend who's been investing in stocks, making him a return of 10%. At the end of year 6, Fred is going to be sitting at $89,112. So we can already see how owning real estate has bumped up Tim compared to his friend Fred. In year 7, Tim realizes he's been doing pretty well on owning his own home, so he decides to buy a pure rental property. Now typically it'd be pretty tricky for Tim to get another loan. I mean, he's making the same amount of money. How's he going to qualify for another mortgage? From spending time going to real estate investor meetups, Tim is actually connected with a private lender. So this private lender will charge a higher rate to give him a mortgage on the home, but as long as it works into the numbers for Tim, he doesn't care what interest rate he's paying, just as long as he can use this private lender to do the financing for the home. Now that Tim's got the lending sorted out, he lets his realtor know he wants to find another property. Now, using a realtor isn't the only way to find a good deal in real estate investing, but if you're doing it part-time, it's good to work with somebody who really knows what they're doing. Tim's realtor finds him a beat-up duplex for around $500,000. Because he's been saving, Tim puts down 10% this time on the purchase of the home. He estimates he'll spend about $30,000 in fixing up the property. In the same way, cosmetics, paint, floor, trim, all this sort of stuff. Tim uses his leftover savings after that down payment to pay for most of the renovations, but there's a little bit that he doesn't really have money for. Now, because Tim's been growing equity in his first home, he decides to get a home equity line of credit to finance the rest of the repairs. A home equity line of credit allows you to tap into the equity you've been building in your home so that you can use it without having to sell the home. So using that home equity line of credit paired with his leftover savings after the down payment, Tim is able to do those $30,000 of renovations, and it turns out that he's increased the value once again by $50,000. Now, because he got a good deal, once he rents out both sides of this duplex, he's cash flowing $100 per month. So that just means he's making $100 extra after he covers all the costs of operating the rental. That means the mortgage, the insurance, the taxes, and maintenance. So now he's getting paid $1,200 a year to hold this property. And that's not even including the appreciation and mortgage pay down that we're also going to see. So now with his $50,000 down payment and his $50,000 of added value through renovations, Tim has $100,000 in equity in this new home. With Tim's yearly savings, he uses it at the end of the year to pay off that home equity line of credit. At the end of year 7, Tim's equity in both homes combined adds up to $241,543. If we pair this with what's left in his savings account, we're at a net total of $252,623. Now Tim has 2 homes that he's making money on the appreciation, mortgage pay down, and a little bit of cash flow from the pure rental property. In year number 8, home 1 keeps on continuing to perform in the same way. Same amount of appreciation, same amount of mortgage pay down, same amount of everything. Home 2 performs in the same way as home 1. So let's just run through those numbers really quick. At 2% appreciation, home number 2 is going to appreciate $11,000 in this year. Now, because Tim used a private lender, he's going to be paying more interest up front than he is going to be paying into the mortgage pay down. So let's just say that he's paying down about $10,000 per year of that mortgage. That gives Tim an extra $21,000 of equity gained in that property that year. Now, if we put it all together, that's home 1's growth, home 2's growth, and his savings that he's able to save because he's living in one of the properties, we get to our total number over the course of these 8 years. Tim has $283,093 in equity across the properties. He's got $34,800 in savings, and that leaves him at a net of $317,893. Now, if we flip over to our buddy Fred, he's been continuously putting in that roughly $10,000 each year because he hasn't been able to save more because he still has to pay those monthly rent payments every single month. But still, he's performed well. 10% is nothing to scoff at. He's at $142,908 at the end of year 8. If we let both Fred and Tim's investments grow at the same rate that we've been talking about this whole time, then we're going to come to their total investment portfolio at the end of 10 years. Let's take a look. At the end of year 10, Fred ends with $197,220. Pretty good. For Tim, however, when we combine the equity with the amount he's been able to save, he ends up at a net $449,153. Now imagine if Tim buys another property and another property and another property. Over time, this is going to be huge, huge, huge growth. I hope that gives you a good idea of some of the differences between investing in other sort of asset classes and investing in real estate. And one of the most important things in my mind is the flexibility of it. Once you own a home, you can start building that equity, and then if you need to tap into it to do renovations or say there's an emergency, you can more easily get a home equity line of credit. In Fred's situation, there's not really a great way to tap into those investments without selling some off. Some people will actually even tap into their equity or a home equity line of credit to use that for future down payments. So imagine if Tim did that, if he was more aggressive and wanted to take those down payment amounts from his equity in his previous home, he could have bought 3 or 4, maybe even 5 more properties in that span of time just with that strategy alone. but you can see how real estate investing is a long-term play. If you hold it for the long term and strategically add more and more properties, it can increase your wealth by the time you've been in it for 10, 20, 30 years by huge amounts. That's why I think it's so important to kind of share this information and to take a look at it if you're interested in it at all. If you've made it this far into the video, I know it's a long one, drop a comment, drop a like. I want to know that you've made it to this point, because if you have, it's probably likely that you might be interested in this sort of stuff. So let me know down below. But that's it for me. Thanks so much for watching, you guys, and I'll catch you next time.